Everywhere you look right now, something feels off. Stocks are at all-time highs. Real estate is at all-time highs. Gold is at all-time highs. Bitcoin is flirting with numbers that would have sounded insane just a few years ago. Rent is at all-time highs. Food is at all-time highs. Healthcare is at all-time highs. College tuition is at all-time highs. At some point, you're supposed to ask the obvious question, are we in a bubble? And if you've been paying attention, you've probably heard the phrase floating around more and more often, the everything bubble. But here's where I want to slow things down, because this is where most commentary gets lazy. Historically, bubbles are outliers. The dot-com bubble didn't lift everything. The housing bubble didn't lift everything. Crypto in 2017 didn't lift everything. When bubbles form, they show up in one place, and you can spot them because everything else looks relatively normal. But today? Nothing looks normal. Gold is breaking out to record highs. Silver is at levels only seen a handful of times in history. Bitcoin is trading in six-figure territory. The S&P 500, Nasdaq, Dow, even small caps are hovering near record levels. U.S. home prices are still near their peak. And basic necessities, rent, electricity, food, education, cost more than they ever have. That creates a logical problem. Because when everything is expensive, the question, is this overvalued, becomes meaningless unless you finish the sentence. This is the part almost nobody wants to talk about. If stocks are expensive compared to dollars, and homes are expensive compared to dollars, and gold is expensive compared to dollars, and food is expensive compared to dollars, then maybe the thing losing value isn't everything else. Maybe it's the dollar. And that's where this conversation actually starts. Every asset price you see is a ratio. Stocks aren't worth 6,500 points. Gold isn't worth $3,600 an ounce. Bitcoin isn't worth $112,000. Those numbers are simply what those things cost in dollars. And if your measuring stick is shrinking, everything you measure with it looks bigger. That's not a theory. That's arithmetic. Since 2020, the US has created an unprecedented amount of money. Roughly 1/4 of all US dollars in existence were created in the last 5 years. Federal debt has exploded past $37 trillion, growing by roughly $1 trillion every 100 days, while interest payments alone have now crossed $1.1 trillion per year, exceeding even the defense budget. That matters more than people realize. Because when money is created faster than productive output, prices don't rise because things become better. They rise because money becomes worse. And when interest rates were pushed near zero for over a decade, borrowing stopped being a decision and became a reflex. Cheap money doesn't just inflate one market. It inflates behavior. It pushes people out the risk curve. It punishes cash. It rewards leverage. It teaches an entire generation that prices only go up. That's not capitalism functioning normally. That's a distorted incentive system. A lot of people keep waiting for another 2008. Another housing collapse. Another banking crisis. Another moment where everything breaks at once and resets. But this obsession with fighting the last war is dangerous. 2008 was a deflationary crash. Assets collapsed. Debt unwound. Cash suddenly mattered again. This time, the risk is different. This time, the system is so saturated with debt that allowing a deflationary reset would be politically and financially catastrophic. Interest costs already threaten to swallow tax revenues. A return to pre-2008 interest rate levels would push annual interest expenses toward $2 trillion, nearly half of all federal revenue. So policymakers are boxed in. They can't raise rates too much without blowing up the system. They can't cut spending without causing unrest. And they can't stop printing without crashing markets. That's not a cycle. That's a trap. And in traps like this, what usually gives way isn't asset prices first. It's purchasing power. The silent gap nobody can ignore anymore. Here's the stat that should make you uncomfortable. Since 2019, the S&P 500 is up over 100%, Bitcoin is up roughly 2,500%, gold is up about 200%, home prices are up around 30%. Meanwhile, median household income has risen roughly 22% over the same period. That gap is not accidental. It's structural. Assets respond to liquidity. Wages respond to productivity and bargaining power. And when money floods financial markets faster than it flows into paychecks, you get exactly what we're seeing now. Asset owners feel richer. Everyone else feels squeezed. And the economy looks strong on paper while daily life feels worse. This is why people feel gaslit when they're told the economy is doing great. Technically, it is, for the top decile. For everyone else, prices rise faster than income, debt replaces savings, and stability becomes an illusion. Let me be clear. This doesn't mean assets can't go higher. Bubbles can inflate far longer than anyone expects. But this also doesn't look like a single speculative mania that pops and clears the air. This looks like systemic monetary debasement. When money loses reliability, people don't rush into one asset. They rush into anything that isn't cash. That's why everything feels expensive at the same time. That's why traditional valuation metrics feel stretched across every market. That's why people can't tell if prices are high, or if money is weak. And that confusion is the most dangerous stage of all. Because when people no longer trust their unit of account, markets stop behaving like markets and start behaving like escape routes. Because no matter how political, emotional, or ideological people want to make economics, at the end of the day, systems obey math. And the math right now is not subtle. Here's the core problem in plain English. The United States is now adding debt faster than it can grow income to service that debt. That is not a moral judgment. That is not a partisan talking point. That is arithmetic. Federal debt is above $37 trillion. Interest payments alone are now over $1.1 trillion per year. Every 1% increase in average borrowing costs adds roughly $370 billion in annual interest expense. Let that sink in. At this point, interest isn't the cost of borrowing. Interest is the borrowing. The government increasingly issues new debt just to pay interest on old debt. That's not investment. That's rollover dependency. And once a system reaches that stage, it loses its ability to normalize. You can't go back to normal rates without detonating the budget. You can't meaningfully cut spending without social backlash. You can't inflate your way out without destroying purchasing power. So policymakers do the only thing left, kick the can and pray growth saves them. But here's the problem. People talk about growth like it's a magic spell. AI will boost productivity, tech will save us, the next cycle will fix it. But growth has constraints. Real growth comes from productivity gains, labor force expansion, and capital efficiency. Now look at reality. The US workforce is aging. Labor participation is structurally lower than pre-pandemic. Productivity gains from AI are uneven and concentrated, not economy-wide. Meanwhile, debt compounds relentlessly. This is the part many people miss. Debt grows exponentially. Productivity grows linearly. That gap widens over time, and when it gets wide enough, something snaps. Historically, countries at 130% debt to GDP don't gently rebalance. They default, inflate, restructure, or politically implode. And the US is already past 120%, with projections pushing higher within a decade. There is no historical precedent where this ends cleanly. Now let's talk about something uncomfortable. Index funds. For decades, passive investing was the smart move. Low fees. Broad diversification. Long-term discipline. That logic still holds in a healthy price discovery environment. But we are no longer in one. Today, the top 10 companies make up over 40% of the S&P 500. The top 7 alone control roughly 1/3 of the index. Nvidia by itself approaches 7% of total index weight in some benchmarks. This creates a feedback loop. Money flows into index funds. Index funds mechanically buy the largest stocks. Those stocks rise, increasing their index weight, which attracts more passive inflows, which pushes prices higher regardless of valuation. This is not the market being smart. This is price-insensitive capital overwhelming price discovery. And the danger isn't that index funds collapse overnight. The danger is that valuations drift far from fundamentals. Expectations become impossible to meet. And when one or two heavyweight stocks stumble, the entire market wobbles. Not because everything failed, but because everything was leaning on the same narrow pillar. Now let's talk about AI, because this is where optimism turns into mythology. Yes, AI is real. Yes, it will change industries. Yes, it will boost productivity in some sectors. But that does not mean every dollar flowing into AI is productive. Right now, AI capital spending looks eerily familiar. Massive upfront investment. Unclear long-term monetization. Winner takes most dynamics. Extreme valuation compression risk. Sound familiar? That's not innovation. That's capital concentration under uncertainty. And here's the darker side nobody likes to mention: AI boosts margins by replacing labor, not by raising wages. That means, corporate profits may rise. Equity valuations may hold. But household income growth lags even further, which widens the gap between asset prices and lived reality. That's not prosperity. That's financial bifurcation. Why waiting for the crash is dangerous. This is where a lot of people get it wrong. They're sitting in cash, waiting for the big crash, expecting 2008 all over again. But what if that crash doesn't come the way they expect? What if instead of a violent deflationary reset, we get persistent inflation, asset prices holding nominal value, and currency purchasing power eroding year after year? In that world, cash doesn't protect you. Cash quietly bleeds. This is why people who played it safe since 2021 feel poorer today, even though markets went up. They weren't wrong about risk. They were wrong about which risk mattered. The biggest danger right now isn't volatility. It's monetary decay. Here's the hard truth. The system doesn't collapse all at once. It degrades. First, trust erodes, trust in prices, trust in savings, trust in institutions. Then behavior changes, people speculate defensively. Households chase assets they don't understand. Politics radicalizes around cost of living pain. Then policy choices narrow. Every response creates new distortions. Every fix worsens the next problem. And eventually, something external forces a reset. A geopolitical shock. A bond market revolt. A currency confidence event. Not tomorrow. Not on a schedule. But inevitably. So let's end where we began. If everything feels expensive, if nothing feels stable, if prices no longer anchor reality, the problem may not be that everything is a bubble. The problem may be that the unit we price everything in is no longer trustworthy. And once a society reaches that realization, behavior changes permanently. That doesn't mean collapse tomorrow. It means the old playbook stops working. And anyone still fighting the last war, waiting for the last kind of crash, is likely to be blindsided by the next one.